we have an amazing panel of speakers.
There is this debate about the deconstruction of the American capitalistic system versus how do we position ourselves to accelerate, thrive, and take advantage of it.
We have to control pools of capital, opening up the access doors so that people can pursue the opportunities that they want to pursue.
20 years ago, the mindset was, if you build it, they will come. Now, we have to meet people where they are.
At the end of the day, what makes the company successful and grow is the people. And if you don't have good people and you're not nurturing people, training people, you're not going to be successful.
We need salespeople, accountants, creators, people who come up with something that we've never had before.
We've seen the roadmap. Now the opportunity is, how do we do more of that? How do we expand that quick, fast, across the country?
Hello, I'm Chris Hairston White, and I'd like to welcome you to the 2024 Big Dipper Innovation Summit, part of the Big Dipper Experience. The summit convenes local, regional, and national entrepreneurs with big thinkers, dreamers, makers, and creators. Together, we talk about innovation and exchange insights and ideas. So sit back and enjoy. Let's shape the future together. In this lively discussion, the diverse landscape of financial services is explored, from investment strategies and economic trends across fixed income assets and private equity to venture capital. If you've ever wanted to understand how finance impacts your everyday life, this session is for you. Let's get started.
Convergence points, navigating economic intersections. If you've ever wanted to understand how the world of finance impacts your everyday life, then this session is for you. In this session, we're going to explore the diverse landscape of financial services, from investment strategies and economic trends across fixed income assets and private equity to venture capital. Whether you're just getting started in investing or you're a seasoned professional, our panelists will share insights on different sectors' approaches to strategy, time horizons, risk, the often discussed interest rates, and so much more. This nuanced and comprehensive discussion offers a deep dive into the intricacies of financial services and the factors that are shaping their evolution in our society today. This conversation is moderated by Aaron Montgomery of the Montgomery Development Group, and our panelists are Bob Green of the National Association of Investment Companies, Dr. Chris Brooks from Brown Venture Group, and Kevin Nicholson from Riverfront Investment Group.
Well, I am super excited about this session. Over the last day and a half, we've had sessions that have impacted our mind and some that have impacted our heart. And I think that this one could very well impact our wallet, because this is a topic that a lot of folks are probably thinking about now, especially given the roller coaster of a year that we had last year. And we've got an excellent panel that brings a lot of different experiences and perspectives on the topic of economics and finance. I'd love to jump right in. But to start, given that you all bring such different perspectives, maybe we kick off with a little bit of background where you share a bit about the investors you serve or partner with, the time horizons and asset classes you invest in, and just give some sense for the perspective that you'll be bringing to the panel. Go ahead and start with.
Awesome. So I'm Bob Green, honored to be here. I represent the National Association of Investment Companies, and it's an organization that many of you all have probably not heard of, but touches you all and your communities in a very vital way. NAIC is the trade association for diverse-owned alternative investment firms. What's that? Well, alternative investments are everything other than public company stocks and fixed income. So we represent private equity firms, we represent venture capital firms, private real estate firms, private credit funds, hedge funds, and other institutional investors. We have 195 members, all of which are people of color, and those member firms represent $385 billion in capital.
Wow.
And one name that we work with that's our largest member that you've heard of is Robert Smith of Vista Equity Partners. So we'll be able to talk a little bit about that, maybe demystify private equity a little bit, but I'm honored to be here and appreciate this opportunity.
Thanks for coming, Bob.
Yep.
Appreciate that. Chris, go ahead.
Good morning, afternoon. I'm on Midwest time, so it's still very much morning there. My name is Dr. Chris Brooks, and I am a co-founder and managing partner of Brown Venture Group. Brown Venture Group is the first black-owned venture capital firm in the state of Minnesota. So we founded our firm based on some data and some metrics. When we founded our firm in 2018, for example, one of the most powerful points of data we discovered was that the most investment-ready, best-educated group of human beings in America was black women. And black women were getting 0.0006% of venture investment at that time. So we started our firm to really try to create brand new economies of scale within communities of color. Our thesis names Black, Latino, and Indigenous entrepreneurs. Since starting our firm, we launched our first fund. We're a member of NAIC with Bob. We have made 34 investments, 100% of them into entrepreneurs of color, and our investments are performing very, very well. So we're really excited about the future of venture. We're really, really excited about the present of venture, and we find ourselves now among an ever-growing group of venture capital firms that are allocating capital to entrepreneurs who previously had no access.
Good morning. My name is Kevin Nicholson. I'm the Global Fixed Income Chief Investment Officer at Riverfront Investment Group. I'm also a partner in the firm. My firm is a lot different than the other firms that we've talked about because we invest in the public markets. So stocks, bonds, and sometimes alternative investments, but mostly it is you're thinking of the 60-40 portfolio that you often hear about in the news media. So our firm is built around managing active ETFs. We will use ETFs to build portfolios that have a time horizon anywhere from 3 to 10 plus years. It's going to range in, depending on the time horizon. The shorter time horizon portfolios are going to have more fixed income, a higher fixed income allocation to them. And as we move further out the investment spectrum, as you get to that 10 plus year time horizon, it's going to be concentrated on 100% equities. We invest both in the fixed income and equity markets globally. So our portfolios will consist of some domestic equities, some domestic fixed income. Sometimes we will have like emerging markets debt in the portfolios, or we'll have international equities as well.
Thanks for that, Kevin. And I want to make sure, I really want to take some time to break these classes down, because I would imagine that given the year that we had, right, where so many things were going on in the economy with rising interest rates or weird things, right, where you've got people abandoning the job market and you're trying to fight unemployment by raising interest rates and all these different things that don't typically go together, that each of you or there's investors that you work with or represent might have had a different perspective on how to think about that, right? So maybe Kevin, since you're in the more traditional asset classes, how did you think about this, looking mostly at fixed income and ETFs?
So the last year was an anomaly, so to speak, just in how fast the Fed actually raised rates. They raised rates by 525 basis points in a matter of 15 months. And so for us, it actually was a boon to our, and revitalized our portfolios because there are so many articles that you read that have said, is a 60-40 dead? And that's the traditional equity to fixed income mix that they would recommend for a retail client to hold. But for the last 15 years, we've had interest rates near zero. And so the fixed income part of the portfolio wasn't doing any of the work. It was all the equity part of the portfolio. So we became a society that was very dependent on equities to meet the retirement needs of our constituents. And that led to a lot more people taking a lot more risk. Yeah. And because the Fed has now more normalized interest rates, it has now allowed investors to diversify into fixed income. It has also allowed the investors to de-risk their portfolios. So we have people now that are getting closer to retirement age that want to move down that risk spectrum, are having the ability to do that. For the last 15 years, they didn't have that ability. They had to play the equity game. Yeah. It was TINA. There was no other alternative. There is another alternative now, and we like to say, TINA has left the building, and now it's pay attention to the income.
Yeah, and not just that they lost out on the growth, they didn't have a hedge, right? Like if it was either up or it was down, that was it. You couldn't,
That's right.
You couldn't balance either way. You talked about that growth. I just want to double back to make sure we've got a clear understanding that dependence on equities is also part of what gave rise to the ETF, right? Is that true?
Yes. So one of the big things with the ETF market is that they wanted to give.
And should we just define it for the sake of folks who might
Yes.
watch later?
So the ETF is an exchange traded fund. And a lot of you, if you have retirement accounts, you would think of mutual funds. That would be the first pooled investment, was a way to gain access to the markets. However, we've moved to ETFs because they are cheaper as far as the way to manage them. So their fee, the expense ratio that that the manager gets paid, is a lot less than you have in mutual funds. And so ETFs gave rise because they wanted to create some diversification. And one of the big example that I like to use, imagine you do all this work on an individual stock. Let's say it's Verizon, for instance. You think that you have all the knowledge on Verizon, and you think that this is the perfect investment. And then you buy that stock, and then a week or two later, it comes out that AT&T has this great deal with another company, and they're going to get broader access, and that stock goes up, and Verizon's just sitting there. So what ETFs allow you to do, it allows you to diversify your genius so that maybe you can buy a specific sector, and you're able to participate in that the upside.
Fantastic. Thanks for that explanation. Chris, venture guys have to be a little bit more immune to these near-term trends because they're making big bets on what's next. These investors are they're counting on you to figure it out, get the return somehow, but we're counting on 15, 20%. Like, how did this most recent period that we've gone through, how did that affect your investment strategy and what your firm's been doing?
So I'd actually like to rewind a little bit. So he talked about this last year as being an anomaly for the business that he runs. The anomaly in venture, especially diverse-led venture capital firms, was the season surrounding the murder of George Floyd. So I live in Minneapolis, Minnesota. I was born and raised on the south side. George Floyd was murdered 3 blocks from my elementary school. Wow. And in the wake of George Floyd's murder, there were many, many companies that made public announcements and huge verbal commitments about finances that were going to flow into black and brown-led companies and institutions. And for those of us that were ready, and Brown Venture Group was in position, for those of us that were ready, that was a boom for us. Also, most folks don't know this probably, but the murder of George Floyd also was the birthing of a bunch of brand new black and brown activity. Many, many brand new diverse-led firms were launched because of that event, and many companies were launched because of that event. We've got a couple of them in our portfolio of investments. So that was the anomaly for us. The anomaly was the murder of George Floyd and the activity that emerged after the companies sort of got their heads together and said, we've got to do something to make this right, for lack of a better way to put it. So we, Brown Venture Group, we called every single company that made an announcement. We had a spreadsheet with a list. We called every single one. We received our capital. Now, I will say that what is sort of unique in our sector right now is that what we call that season the George Floyd effect. Well, the George Floyd effect has worn off.
Yep. Yeah.
That season of sort of like an increased opportunity to receive capital, the amount of capital that was being pushed into the ecosystem, that was in some ways very unique. And we're down cycle. Right now raising money is hard in America right now, if you're of any color, right? But if you're an entrepreneur of color or an investor of color, it's extremely hard to raise capital right now. So I can speak from a first person and a firm perspective and say, we did the best that we could to get as much as we could. Yeah. And we are really, really wisely managing and stewarding those resources. And I think that's probably the message that I wanted to send to the room about this today is, we're in a season where you have to be really, really wise with your stewardship of your resources, which does not mean you avoid risk. I live in venture world. We are, by definition, a risky part of the ecosystem. But you've got to be wise and discerning. And as I was on my way over here, actually, in the car, I was thinking about how much time you spend preparing for things that matter, right? Like if you're going to go on a vacation, how much time would you spend researching resorts, researching restaurants, researching ticket prices, like getting those Google alerts to get the best price. Like, we do all that, right? Your investment portfolio, the way that you steward your financial resources is no different. And we're in a season right now where you've got to crank it up a notch. And you've got to do hours and hours of research on a sector that you want to invest in. You've got to do hours and hours of research on a company that you want to invest in. You've got to do hours and hours of research to make sure that you're getting the best value and the best services from your financial advisors and financial managers. And in venture, we're no different. We have, because of this economy, because of this down economy, if you want to call it a down economy, I believe opportunity is everywhere. But because of the current economic conditions, we have just really turned up the volume on our due diligence. We've turned up the volume on our research. We've slowed down the pace of investment. We've slowed down a wide variety of things because we want to proceed with an appropriate amount of caution. And again, we take risks. So I'm not saying stop doing the things that you've been doing. What I am saying is slow down, spend maybe a little bit more time. I spend a lot of my time also focusing on the African ecosystem. I'm a senior advisor to the Nigerian diaspora investment folks, and we've seen a couple of unicorns die in Africa this year. Unicorns meaning companies that were $1 billion value. This is just a season where you've got to be really, really good and solid with your discernment, with your due diligence, and therefore be really, really good with your stewardship. And if you do those things, you'll come out on the other side in a position to really take advantage of these fantastic deals that are emerging right now and probably will emerge even more over 2024 as you're able to negotiate a better deal based on the economy.
I think even in that story of that initial expansion of your firm, right, that notion that luck is where preparation meets opportunity, right? You were ready, you had the dry powder, you knew that there was something coming, and when it came, you were ready to take advantage. Bob, given the broad cross-section of folks you work with, there's probably not a single consensus theme, but there probably are some echoes of some of these different ideas. What have you seen over the last several years?
Yeah, I think the first thing is to take a step back. I want to meet the audience where you are. How many people in the room have a 401k? Raise your hand if you have a 401k. How many people in the room, thank you, how many people in the room have a defined benefit pension plan, meaning that when you retire, you don't have a 401k, but you're guaranteed your paycheck continues? How many people have that? Okay, so two groups, 90% of you have a 401k, and about 10% of you have a defined benefit pension plan. The reason that is that over the last 25 to 35 years, corporate America has said, we don't want the responsibility for managing your wealth, that's what it is, for your entire career. We'd rather shift that responsibility to you. So we'll talk about two types of plans: defined benefit, which means that you work, you give a certain number of years, and then you get a check for life of some measure, some percentage of what you were earning, and defined contribution, also known as a 401k. When that shift happened, a good thing happened. You got to keep the principal. Because if you have a defined benefit plan, when you pass away, your family does not get the principal anymore, and the checks stop. Maybe there's some widow continuation or husband continuation, but generally speaking, the liability and the responsibility to pay that money stops. In the 401k, you get the balance, right? But here's what you don't get. You don't get the benefit necessarily of professional investment management, right? You now have the responsibility to manage your money for life, right? So I spent a little bit of time running a pension plan here in the state of Virginia called the Virginia Retirement System. Virginia Retirement System basically provides benefits, insurance, health care for the vast majority. They are the largest benefit plan in the state. They still have a very large defined benefit plan. So why is Bob talking about this? The reason I'm talking about this is because the job of both of these gentlemen is to help the pension system and many other institutional investor types manage your money, right? If you have a 401k, you likely don't have exposure to them. So as they're talking about interest rates, as they're talking about fees, as they're talking about return horizons, you, 90% of the people with the 401k have that responsibility for yourself for life, right? So it feels good when you see the money I've got 10,000, I've got 55, I've got 75, progressing towards retirement. But you need to have a hawk eye on what you're actually going to need in retirement, right? I will offer you something very sad. With a defined benefit, with a defined contribution 401k system, it is wonderful for the individual, but you have all the responsibility. And what's scary is if you fail in that responsibility, what happens, right? Time is the greatest asset you have, right? The longer time you have, the more you can take risk. The more you can take risk, the more you can potentially generate higher return, the more you can create wealth. The greatest wealth in the African American community, by example, sits on Main Street. 35% of the capital, 35% of the people that work for the state of Virginia look just like us. They're people of color. But when November rolls around and it's time for the elected officials, the mayors, the governors, and all of them to come in, who do we see? We see the mayor. We see the governor, right? They come into black churches. Some churches let them in the pulpit. Some pastors fold their arm and look sternly at them. And we just take that pause often as the white person comes and asks for our vote. And we see them again, depending upon the election cycle, every 2 or every 4 years. Here's a better opportunity. When's the last time you saw the chief investment officer walk into the black church? When's the last time the chief investment officer, the person responsible for managing the greatest wealth in the community, when's the last time he or she walked in? Does anybody know his or her name? This individual has the opportunity to write checks of $100 million on signature authority. The governor cannot do that. The mayor certainly cannot do that. But you have an individual in an office on Main Street writing that type of check on your behalf to these gentlemen and to the ladies and the other people at the firm. And that's a good thing. Both of them, I know their firms, they do a great job. But we have got to start acting like our lives depend on it. Because if you're managing your 401k, trust me, your life does depend on it. And I'm not trying to scare you. I'm simply trying to say premature withdrawals, loans for cars. There are a lot of things that we're doing that we wouldn't do if we thought really what this money was, right? The state wouldn't let you go get a loan on it. They definitely wouldn't let you take an early withdrawal and take all the taxes and penalties. So I want us to know what we're talking about. So as they talk about the asset classes and the things that they do, the asset classes they represent are designed and intended to generate a certain type of return, right? Fixed income is designed to get a certain type of return with low risk. Venture capital is designed to get, hopefully, a much bigger return with some managed, some smart risk. So we'll talk a little bit more about the different asset classes, but that's where we are, and that's really the intersection that this panel talks about, the intersection of governance and wealth. And we trust the state of Virginia, if you're a VRS person, to manage us from a governance and a wealth standpoint. If you're in the city of Richmond plan, same thing. So that's what we're talking about, and we want to make sure that you all are connected to this with your wallets, but also with your hearts.
Excellent, excellent points all. I want to push on that point though around the, this push from defined benefit to defined contribution plans and what that impact has meant. I've got a friend who's a college consultant. He put together a spreadsheet that said, based on where college costs are going and based on what you have in your 529, this is what you would need to afford a school in next year. My daughter will be class of 2035 in high school, and I'm told that she would need a 529 balance of $250,000 to be able to afford a top school by then. And that seems to be fairly common. Maybe for an in-state school, it's a little bit less, but the way prices are going, that's a lot. That's a lot, and it's hard. And thankfully, 529 benefits are locked up in ways that you can't access them as easily. But like you said, these early withdrawals and things like that, like life happens. This is a really, really big job to take this principle, hold on to it, invest it wisely, not have anything bad happen, and then hope that the market cooperates when you need to withdraw it. What do you tell people? It feels like both hands are tied behind the back. There's no wind at your back. Like, what do you actually do?
Yeah, the first is to get some professional help, right? Like every other aspect of society, you wouldn't build your home by yourself. You wouldn't go out and buy parts to build your car by yourself. So don't try to build your financial future by yourself. Get some professional help. Professional help is going to help you identify what your goals are. Professional help is going to help you identify what your risk tolerance are. If you can't sleep at night because the market's going down, or if you have I just got rich syndrome because the market went up, that's the wrong behavior over the long term, because you're supposed to be thinking about this in a 40-year sense. We've all seen a transitory job market, right? Most of our parents, if they worked in either corporate America or for the state or taught school, they worked the same place for 30 years, right? They could put a sense of blinders on because they were in a defined benefit system. They could tell you 30 years from now what your pension check was gonna be, right? But if that burden is on you, if that responsibility is on you, you have to educate yourself around it. So you have to read, you have to develop some sense of what it means to manage money over a 40-year period. And then lastly, you have to be disciplined, right? And not disciplined in the sense that you don't spend any money or you have no other financial goals or you just tuck your head in and like, no, but you understand that you're gonna make a certain amount of money. You actually have to come to understand how that's going to grow and change over time, and what portion of that are you retaining? Are you retaining the minimum in your 401k? Are you putting the max in the 401k? Are you getting a match from your company? And what other alternative sources of income do you have? What degree are taxes gonna play in that? Those are very complicated questions. If you're a kindergarten teacher, like my mother was, you may not be able to answer all those questions. Your brain may not be synapsed in a way that would allow you to think about that. Get some help. Yeah. And if you get that help, stick with the person, because insurance plays into it. You talked about educational savings, home savings. We have a phenomenon that we've advised people on in many, many years, which is to put as much money into your house as you can. Because when that advice was being provided, the housing market had never gone down. As you will hear, we are in a fundamentally different housing market. And you start to look at it, you don't want to be house poor, right? You want to have the liquidity to put money into other things like their funds that are going to generate return for you.
Kevin, my mortgage rate's 9%, my car loan's 12, daycare's $1,500 a month. You know, how do I pull all that together and do what Bob said? Like, where do I start? Like, where?
I think the very first thing you have to start to think about is, Bob pointed out, you kind of have to put these things in buckets. You got to think of your investments as buckets. And when you start thinking about the strategy of how you're going to invest for the long term, you have to think about, well, I need X amount of dollars to send my kid to college. I need X amount of dollars to live off of. I need X amount of dollars for me to retire. And you just start putting these things in buckets. But the one thing about finance that I think is the most important thing that everybody has to remember is the power of compounding. So the earlier you start, the better off you will be. There's often studies where they talk about, individuals who first started on their job at, say 22 years old, and they started investing in their 401k right away. They started maxing out their contribution right away. And then there's the study of the person that starts when they're 32. And there's about $1.5 million difference at the end of the rainbow when they get to retirement age because of the power of compounding. Even though that person started with just a little bit of money, it compounds over time. And I think that that is the most important thing as individuals we have to remember when we think about investing. I think Bob hit on some very important parts of knowing and understanding your risk tolerance. I think that is one of the things that I often find, because my client base is, I never see the end client. I'm always talking to the financial advisor. So I don't know exactly what the end client's investment objectives are. But what I do know is that if they give me a time horizon, that I need to try to protect those investments for that time horizon. And when clients are, I think one of the biggest mistakes that individuals make with their personal finance is comparing their financial situation to their neighbors. Because one of the things that often happens is people go to cocktail parties and they go, oh, well, I own Apple and it went up by, 10% last week, and so then they start comparing. But everyone's circumstances are different, and I think that that's the important part, is that you need to focus on your own individual investment objectives and your own risk tolerance. Because just because someone else has a risk tolerance to have a particular equity in their portfolio, you might not have the same risk tolerance. And so I think that is one of the biggest things that you have to learn when it comes to when investing. And especially since when we're talking about 401ks and you're having to do it yourself, I think that having professional management always helps. And I'm not saying that we as professionals are right all the time. We're not. But one of the things that I've learned in my 32 years in the business is that you want to fail fast. You don't want to make the same mistakes over and over and over again. And oftentimes what happens when people don't have their investment objectives aligned with their risk tolerance, what happens is they will buy and make an investment, and they will end up riding the wave, and they sell it at the wrong time. So they sell it at the bottom, they buy it at the high, and then when you have a market go down or you have an investment go down by, let's just say 5%, well, it takes more than 5% to get back to even. Right. And oftentimes people get shaken out of their positions for that reason. And that's why you need a financial advisor there or some type of professional, because investing is very emotional, very emotionally driven, and you want to have a neutral party there that doesn't have that emotional attachment.
That's an excellent point. Even doctors have doctors, right? It's good to be able to step outside and let somebody hold your hand during those times, right? If the stock goes from 4 to 2, it goes down by half, it's got to double to get back to 4. Yep. That can be painful to see, and we saw some of that not too long ago.
When we come back, we'll discuss disciplined approaches to finance and look at issues around financial literacy and wealth disparity in America.
Chris, how do you balance that opportunism with the disciplined conservatism of staying the course? My mom telling me a story years ago of how she knew a computer nerd back in the early 80s who was telling her about this little stock in a company called Apple. And she just thought it was ridiculous and didn't think twice about it. And now she kicks herself 40 years later for having missed that opportunity. There are things today, our entire S&P is driven off those tech stocks that used to be so speculative back then. It's hard to know in real time and not until you look back. So how do you balance that opportunism? Like when is it a real opportunity versus a GameStop or an NFT or something like that that's just a fad?
Yeah, I'll give you an example from our portfolio just to take it down to a real level. So we made an early investment in a company, a technology company. They had what we thought was a really brilliant idea for a medical device. The entrepreneur actually had the idea many, many years ago, but it was before Siri and Alexa, so the voice activation technology did not yet exist to help this entrepreneur's medical device idea come to life. So the technology caught up. He had already filed a patent. We thought that was brilliant. We invested some initial capital to get him going. Along the way, we discovered that there were these technology transfer offices all over the nation, and one of the most powerful ones was NASA. NASA has all of these devices and innovations that have tens of millions, sometimes hundreds of millions of dollars of R&D in them. They put them into use in outer space, and then they cannot commercialize them on planet Earth. So we got very interested in this. We built a relationship with NASA, and along this journey of us getting to know NASA and their technologies and us investing in this individual entrepreneur, a light bulb went on, and we said, what if our entrepreneur, who's a genius and a tinkerer, could get access to some NASA intellectual property and work on some NASA stuff. So we figured that out. Our entrepreneur found a piece of NASA technology, licensed that technology for something like $2,500, because it's federal, so they keep the price point very low. He took that technology, tinkered with it, developed some brand new technology based on the NASA technology, got brand new patents. This all happened within like an 18 to 24-month period. Took that new technology, so just for visualization, it's a breathing apparatus. So like if an astronaut's in outer space, they breathe into the breathing apparatus. It sends points of diagnostics down to planet Earth so that ground control can say, they're healthy or they're experiencing this or that. So he took this actual, device, this apparatus, and was able to embed all of that functionality on a chip. So now instead of this thing, he's got a chip. Well, chips fit in cell phones. So he took his chip and started talking to Samsung. And I'm proud and happy to announce that within the last few months, that entrepreneur was able to get a $200 million LOI from Samsung.
Wow.
So the question becomes, how do you recognize opportunity in the middle of what feels like a very inopportune time in the market? Well, I believe it actually comes down to discipline, right? We had to build the discipline of making strategic investments into entrepreneurs based on some very specific characteristics. We had the discipline of researching interesting opportunities, and when we discovered that NASA had these capabilities and this IP that was dormant on their shelves, we leaned in and executed the discipline of researching those technologies. They've built a lot of stuff over the last several decades, so their IP library is massive, but we curated. And now, sort of the capstone of this part of my monologue is, we've now built a relationship with NASA to the point where entrepreneurs of color around the United States are getting curated access to NASA IP to build brand new companies based on NASA IP that, again, has tens or hundreds of millions of dollars of R&D already into it. How does that translate into this room? If you're sitting in the room today and you're wondering, how do I read the wind? I think the question was, how do I discern or how do I know what types of investments to make or not to make, what types of risk to take or not to take? I think there are some disciplines, and we've discussed them. I'm sorry if I sound redundant, right? Managing your money, stewarding your resources, you'll need some professional help for that, unless you're in the room and you're like a registered investment agent. But I believe even RIAs probably have their own folks that are looking at their money with them. You do need to have somebody who, this is what they wake up thinking about your money every day. Yeah. They wake up thinking about your best interests, whether it's you individually or you as part of a plan, every day. And they are measured and held accountable to see your money grow simultaneously.
Bob, you look like you had something to add?
Yeah, I actually want to talk about breaking a cycle. Breaking the cycle is very important. As parents, we know that there's certain conversations, particularly as Black parents, that we have to have with our children, right? We have to have certain conversations with our daughters, and we have to have certain conversations with our sons, and we have to have certain conversations with both of them. Why is it that we rarely talk to our kids about money? Right? Most of us have the experience of once a month, once every 2 weeks, we may have watched our parents pay the bills. And if your parents were like my parents, you got the go on now speech, right? If you came too close to that kitchen table or that card table or wherever it was that those checks were being written out, and you started looking and asking questions, you got the go on now speech. And the go on now speech was actually pretty short. It sometimes involved a hand, and it often involved a stern look. Go on now, go on now. And we do that to our own detriment, because what we create in our children is a focus on money is for consumption, right? How many people's parents told them when they turned 15, 16, it's time for you to get a job so that you can buy the things you want? That plays out when we're 25, when we're 30, we're 50. We get a job to buy the things we want. What about if somebody told you, get a job, create money, so that you can have the happiness you want, right? Sometimes the happiness you want could be in a thing, Other times it could be looking at the money grow, right? But if we don't teach our kids what money really is, when they get older and they're still on that payroll and they're in college, they're taking on a significant amount of debt, got to do what you got to do. We have them in a situation where they go from living with us to being indebted into society. And they spend the rest of the time until they retire being that way. I would encourage us to have a meaningful conversation with our children. Have your children understand what it costs to provide the roof that they sleep under. Have your children understand what it costs to provide health care. Let them see the doctor's bill, right? Let them understand that you have to save, mama and daddy have to save for college, right? That you've got to do, gas. Here's what gas costs. Ask your kid, what does a gallon of milk cost, right? What did it cost last week? What did it cost in the store this week? Have those ground level conversations with your kids because it will instill in them a sense of conserving money, money being a tool, and also money being an asset. You want your kids to think like that. And we learn this in the church. Train up a child in the way, and they will not depart when they get older. But if we don't provide the training, right? If it took you a lifetime to learn it, are you going to put your kids through the same thing and ask them to learn it when they get to be 40, right? So I would encourage us to, let's start to break the cycle by having a simple but ongoing conversation with our kids about money.
I love that idea, and I think it's a great admonition. I want to double back on that point, though, and test a hypothesis with all of you. It feels like a lot of the advice that we would give in having those conversations tends to get outdated at the very point that we would exercise on it. I'll give you a few examples. Go buy a house. It's a great way to store wealth. So you do that, and then the 2008 housing crisis happens, and you're the last one in, the first one to get crushed. Yep. Build a business. It's a great way to build wealth. You go do that, and then COVID comes, you're the last one in, you get crushed the hardest, you don't get the loans, you get flushed out. Go to college. Sounds awesome. Supreme Court shoots down affirmative action. You get laden with bills. You're trying to figure out, right? And it seems like, are we at risk of doing the same thing? Is it the right advice to make it such a personal burden and like you have to figure this out? Or are there other things that we should be doing, whether as a matter of policy or societally, or other things that we're letting these same people down with by not doing?
Yeah, I mean, look, if you follow the trends, right? If your greatest investment advice came from the barbershop or the beauty parlor, right? So-and-so bought Bitcoin, or they bought Ethereum, or they bought this. I have no knock, so don't rush up to the stage afterwards and complain to me, Mr. Green, you're shooting down Bitcoin. I am not. What I'm saying is that can't be your only investment. Mm-hmm. What I'm saying is that the stock market, I don't advise you to go put your money in stocks tomorrow because you heard one of us say something great about a particular company. There is a disciplined approach to building a foundation that no matter what the cycle is, right? See, when you get caught playing the short game, then you're subject and exposed to the risk of a cycle. Yeah. But if you play the long game, you'll be okay if you stay in the housing market long term, sure. If you buy right and hold, right? But if you're trying to flip, flippers got hurt, right? Homeowners that had 30-year mortgages, they actually did better because interest rates went down. They got the ability to finance, maybe take some cash out and do some other things. As black people, we have got to stop emotionally playing the short game and put ourselves in a position. And if you can't put yourself in a position, put your kids in a position to begin to play the long game. So that would be my answer to you, not to play cycles.
I like that, Bob. Kevin, please.
I think that the thing that we have to do in order to break that cycle, first and foremost, is we have to become financially literate. And we have to do that at a young age. Because I know for me, I fell into the financial services industry. And I think I was sharing the story with someone earlier. It wasn't until about 11th grade that I even knew what a stock was. Because my family, we couldn't afford to have stocks and bonds. But I think the greatest disservice that we do in our educational system is that we talk and teach about everything else, but we don't teach these students about financial literacy. How to balance a checkbook, for instance. You know, how to save for a particular, for education. how to invest. You know, those are the foundational tools that we need to break the cycle. So it really isn't, in my opinion, about whether or not you ride a wave or not. It's becoming financially literate at a very young age so that you know the difference of what is a cycle and what is just a trend for the moment.
Yeah.
You know, because cycles are long-term, trends are short-term, and they change on you every day.
Do you foresee a future where that education can, right now it's largely nonprofits, it's forums like this, it's books, but will it ever be in schools? Will it, like, it sounds so foundational. As Bob said, this is your life in your hands, but no preparation for it anywhere.
So, you know, I don't know. I'm hoping that one day it will actually be instituted in our school system, but one aspect of it that I can at least attest to right now is there is a charter school here in Richmond area, Cristo Rey, and it's a national charter school, and their program, the way that it works is that they send students starting in the 8th grade to firms, to companies, and they send the student each day of the week, and it's for the entire school year. And I think that if these corporations would actually take the time to create financial literacy programs when those students are there, that helps. I know at my firm, we have 4 interns that come in throughout the course of the year, you know, Monday through Thursday each week. And what we've done is we've created 5-minute videos on every topic that you can think of that would come up in financial literacy. So we've created 34 videos, so effectively enough videos to watch the entire school year. Wow. You know, starting with simple as what is money, and you know, and to you know, balancing a checkbook, how to use credit cards, the whole gamut. But I think that, you know, these 8th graders are having the opportunity to then interact with us and ask us questions so that they can understand it. Because a lot of times, as we've pointed out on this panel, these conversations aren't going on in the home. So it's incumbent of us as a society to get back to the roots of how it used to be everybody's problem, not just your problem.
Yeah. Can I jump in and make a point on that?
Sure, please.
It depends on what you ask for. If you are in a major city and there's a prime piece of land and a real estate developer wants to develop that land, you can ask that real estate developer to build, in addition to the high-rise condos and the single-family homes, you can ask them to build mixed use. You can ask them to build affordable housing. You can ask them to build retail. They're putting a community in with no playgrounds, no parks, and no swimming pools. You can ask them to build that, because at the point of the deal, the conversation can happen. There is no institution on Wall Street that wants to manage your pension plan or manage your 401k, that if you ask them to provide en masse, provide education on financial literacy in schools, and make sure that it's a person with an Ivy League degree, they'd send that person in a minute. You can ask these gentlemen. They would be there on Tuesday like it was their job because they were told to do it. But the problem is that corporate America is never going to wake up and tell them that. That's an incremental cost. And if that incremental cost can't be tied to a revenue stream, corporate America is not built to do it. So again, back to that intersection, how many of our elected officials know to ask for that? How many of our mayors, how many of our city council members know to ask for that? They are trained to ask for certain things, pattern recognition, so-and-so got this, so we're gonna ask them for it. But you want the schools to be fixed? Ask the financial services companies to fix them, or tell them that you will not be investing with their firm, and the schools will get increased funding.
Great points, and given it's such a long tail, right? It's like it's the kind of thing that you have to advocate for early, because the effects are forever. I've done some volunteering. We've seen, to your point, Kevin, we've seen 8th graders sit down, do that work, balance a checkbook, you know, pretend to allocate a budget, and they go home and they apologize to mom. They say, "Man, now I know why you said no. I get it. You know, like I didn't need those shoes. Thanks for being there." But very quickly, what opportunities are you excited about? And now that we're through most of this noise, we think we're close to a soft landing. Maybe intelligent folks can disagree, but what are you excited about going forward?
I'd love to lead out on this one. So when we started Brown Venture Group, we started with a very simple idea. that entrepreneurs of color were an undervalued asset with huge upside potential. That if we could figure out how to make strategic, appropriate, wise investments in the most deserving entrepreneurs with the best ideas that were market ready, that we could actually see disproportionately good results. And we are learning that that is truer than we ever believed. Because of the experiences that communities of color go through, we've got grit, we've got resiliency, core characteristics of what it takes to be a good entrepreneur. There's so much innovation in entrepreneurs of color across America right now that, like, from a deal flow perspective, you know, the companies that we get to look at that we can potentially make investments in, we can't shut off the spigot. It just never stops. It never stops. I probably get between 5 and 20 emails a week from an entrepreneur somewhere in America that has an idea that they want to get investment for. It just never stops. I want to cross-reference what I just said with some data that's global data, because I want to make a really specific point, because the question was, what are you most excited about? In the next 25 years, or by 2050, North America will grow by 39 million people from like a population perspective. The African continent will grow by 795 million people. That's 20x. Now, I think of every black person on planet Earth as part of the African diaspora, even though I'm hood black, right? Like, I think I'm part of Africa. So if you think about black global opportunity and 800 million new citizens on a black continent, I'm extremely excited about the black future.
Absolutely.
I think blackness is going to be the growth story of this century.
That's awesome. That's awesome. Kevin, what's on the horizon that you're really excited about?
Well, you know, markets aside, I think the thing that I'm most excited about is that I am now seeing people that look like me in financial services. I started my career as a bond trader, and for 15 years, I was the only one on my floor. And now I am seeing so many young African-American men and women and other people of color that are entering the industry. And I think that, to me, that is the greatest thing to be excited about, because that also brings a diversity of thought, and that we get away from doing things just because the way it's always been done that way.
Absolutely.
And it represents a uniting of, you know, the community, in my opinion. But from a market standpoint, I think I kind of led with this, is the fact that we have a normalization of interest rates, and we are taking some of the risk out of investing, especially for people that are getting later in their investment lives.
Yeah, that's great. I think to your first point as well, what great allies to have in this endeavor to build financial literacy than a bunch of black financial professionals that have been out and have different perspectives. So great timing for that in this conversation. Bob, what are you excited about?
Yeah, I'm excited that we're finally having a national conversation about wealth disparity in America, right? We've pretended for so long that it didn't exist. If you look at the movements, starting with the civil rights movement, the civil rights movement went to a point where it was able to, through policy changes, kick down doors and give people access. Then we went to an access movement where we were pushing people with job programs and with development programs in universities like Virginia State, pushing people into corporate America, right? But what we found out over time is that that wasn't changing the wealth mix in this country. Now we're having a conversation. 10 years ago, we didn't know that an African-American household had 1/7 the wealth of a white household, the average of each. Now we're having that conversation, and when you start to have the conversation, you see people's eyes open up, right? You see people being de-gamified around what wealth and what capital and what entrepreneurship is in America. When I was a kid growing up in Henrico County in the 70s, there were 3 archetypes, right? If you were a good student, you were told that you could be a doctor, you could be a lawyer, or you could be an engineer. And it was through a program like Inroads that I was able to understand and become better informed about narrower choices, micro choices within that. But let's just face it, all of our kids are not going to be doctors and lawyers and engineers any more than all of them are going to be college graduates, right? We have so emphasized the importance of a college degree that we forgot about the trades. Yeah. We forgot about the fact that that man on the truck could actually be a plumber and fix your house and get you to write him a check. He could get a second truck and a third truck and a fourth truck, and suddenly he could create wealth for himself. So I'm excited that we are in a conversation about wealth disparity in America, because if you think about it, Big Dipper, there isn't a problem that we face in society that doesn't trace back to deficiency of wealth. Not for black people, it isn't. You talk to me about student loans, you talk to me about housing, you talk to me about health disparities, it all traces back to a lack of wealth. So if we can truly put our finger on fixing wealth in America, right? It wasn't until Dr. King started talking about that they trained their anger fully at him.
Yeah.
And you can look at that in America, but we have to have that conversation. We have to hold our elected officials accountable. We have to hold corporate America accountable. And we have to do what both of these brothers have talked about, which is support, build, and uplift our community through entrepreneurship.
Love that. Yeah, shared awareness of this problem, start to focus on solving it. Thank you to all of our panelists. My ears are smoking. I don't know about you guys. I can't wait to rewatch this one. This was a lot of gems, a lot of nuggets, and a lot of things from a lot of different cross sections. So certainly intersectional, I would say. But great job, and thank you all for being here. Really appreciate it.
Thank you. Thanks for having me.
Thank you to our guests, Kevin Nicholson, Dr. Chris Brooks, Bob Green, and to our moderator, Erin Montgomery. Special thanks to JMI, Virginia State University, and the Big Dipper Innovation Summit partners for convening this vital conversation. Learn more about Big Dipper Innovation by staying connected with us. Join our community of founders at BigDipperSummit.com.